Hello, welcome to Farmgate. I'm Finlo Costain, editor of 8.9.com. Today we're discussing the new book, The Profitable Farm, Balancing Business, Nature and Energy Through Maximum Sustainable Output. And I'm joined by the authors. Chris Clark is a management consultant who now farms at Nethergill in Upper Wharfdale, Yorkshire. And Brian Scanlon is a maths and physics graduate who specialises in operational management. Together they are Nethergill Associates, and the book is a practical guide for farmers seeking greater resilience and increased profitability. Welcome both. Chris, let's start with the importance of energy transfer and energy balance. Why are these both so critical to understand?
Well, just before we get into that, Finland, let me just correct something. I no longer farm at Nethergill. I'm now in Devon.
Okay,
So,
right.
okay, so
Very different moving down there.
yeah, what you can see behind me is where we live, and a very dry field at the moment because we've had no rain. Even last night we had a little bit, wasn't enough to bring the greenness back into some of the grazing. So
Yeah.
we're very parched. So
And just for those who aren't watching but are listening, the landscape behind is very standard Devon. There's sort of pasture with a couple of cows there. Are they Angus? And then you've got
no, they're Dexters.
Dexter's, and then you've got a farmhouse and what looks like a conifer sort of mixed plantation or forest behind.
Yeah, that's not ours. That was planted in the 60s and 70s to as a part of a tax incentive. We have some of that, and we are felling that over a period of years, and we are trying to reintroduce the Devon ancient woodland with all its associated flora and fauna.
Fantastic. That's a long project, if ever I heard of one.
Indeed.
Brilliant. And of course, the book goes into natural capital. I'm not sure how much we'll cover natural capital today because we've done a long series on natural capital earlier this year. But obviously, if that comes up, then we'll chat about it as we get there. Let's go back to the idea of energy transfer and energy balance.
Okay, well, what is farming? Farming is about harnessing the sunshine. And what hasn't been realized is that farmers and farming are the most important converters of energy in the UK economy. Farmers have access to 250 million nuclear power stations worth of solar energy. That's what lands on the agricultural land and is available to farmers to convert into food. They knock into a cocked hat anything that BP, Texaco, Shell, any of these boys, any of Centrica, any of them, the farmers are the most important converters of energy in the UK economy.
But it
And
sounds like the capacity factor that they're achieving isn't necessarily as great as some of those energy companies that you've talked about.
well, certainly the losses are huge. The conversion losses from the sunshine into beef or wheat or barley, they are huge, but they come for nothing. They're part of the free issue. And so we end up with the concept, and I can still remember the day that Brian and I stood in our when we were still at Nethergill. We stood in our dining room, and I said to him, "Well, food is a fuel." And he went on to say, well, if food is a fuel, fuel is energy, and farmers are subject to all the laws of physics associated with energy. Now, that may sound complicated. It actually isn't all that complicated, but farmers produce food. Food is a fuel. Fuel is energy. And that is where this energy transfer and why energy is so fundamental to understanding the success, whether it's success in sustainability, success in conservation, or success in business through profitability comes from.
In the book, Chris, in the introduction, you talk about a bizarre paradox that surprised you at Nethergill and then sent you on this journey. What was it that surprised you?
Well, I went to agriculture college, and my wife tells the story much better than I do, but we were told on the first day of college that if you didn't own a farm, you weren't going to ever own one. Well, apparently I saw that as a red rag and decided that by the time I was 50, we were going to own our own farm, and that's what we did. Um, but when I, but to help us achieve that, I had to go through various iterations. One of them was becoming a management consultant, so I could raise enough capital and generate enough finance from banks through debt to buy land. And so I had the capability, because I'd been a management consultant for a while, dealing with SMEs. I had the capability to do budgets. And yet, when I bought the 400 acres, just under 400 acres in North Yorkshire, none of my budgets came true, came to fruition. And we tried more fert, we tried more feed, we tried this and we tried that. Um, we were surviving on the support that we got from, in those days, HLS and BPS. And but the farming enterprise, the beef and sheep side, was not contributing. In fact, it was draining everything else we did through bed and breakfast and self catering and the support mechanisms. And I don't know how I don't recall how it happened, but we started reducing output. I think probably because I got so fed up of loss making that I wasn't going to close it down, but I wanted to see what happened. And we realized then that as we reduced our output, our profitability didn't increase, we didn't have any, but our losses decreased on that particular on the farming enterprise.
And when you say reduced, by how much were you reducing it?
I suppose we were negative before support. The contribution or the losses were drawing out probably 20 to 30% away from the profitable enterprises. And so we suddenly went to break even. We never made huge profits out of the beef and sheep, but we went to break even. And then the contribution from the bed and breakfast and the self catering and the farm walks and the nature conservations that we were doing suddenly had an extraordinary effect on our business.
When I asked the question about the degree to which about those reductions, I was actually not meaning the reduction in the losses. I was meaning more the reduction in the number of stock that you had versus what you had before.
Okay, well, it wasn't that, again, not huge. And this has been borne out with what we found subsequently. We reduced our output probably by about 15%.
1.5.
1.5. Yeah, not huge.
And in terms of that farm that you were farming, what sort of scale was it? How many acres were you there? And how many beef and sheep animals did you have?
So we were a hill farm, and we had really difficult wet land. Sometimes we had 120 inches of rain, and we had a big area of what was called outer shore moss, and that was a peat blanket bog, peat-based area, not entirely, but largely, and we ran Dalesbred sheep and white-bred shorthorns. And one of the things that changed for us was that we realized that we could not house the number of stock that we needed to farm farm properly, because we couldn't grow the right winter forage and we couldn't winter outside on that land. Yeah, now I would wonder whether we should be farming it at all in the way that we were. But so we brought in belted Galloways from a neighbouring farmer. And there was an exchange of baling and this, that, and the other. I don't think any funds ever changed hands, and that's how we operated. So we probably ran about 40 or 50 belted Galloways and some white-bred shorthorns, which we were doing as pedigree, and some Dalesbreds as well, which actually we tried with Derbyshire Gritstons and some lonks.
So the fundamental change here, I guess, was that you were adjusting the number of stock that the land could carry based on what the land was able to produce, where before perhaps you just had an idea of the number of cattle that you could deal with on that space.
Well, it was when we arrived, it was all sheep, and it had been ravaged by lambs coming on or sheep coming onto the farm between April and November or October, and taking everything out and not putting anything back in. And we realized that cattle have to be part of a livestock rotation, a livestock enterprise. And again, that has also been borne out from the 360 farms that we've reviewed. We now know that, for example, that the least profitable livestock farm is all sheep. The next least profitable is all beef, and the most profitable livestock farm is beef and sheep with a ratio of 60-40 LSUs in favor of beef. Now, we didn't know that at the time, but we intuitively, viscerally went to those sorts of ratios.
So when you bought the farm, you were effectively buying this fantastic piece of land that was able to convert energy. And you had these conversations around the kitchen table with Brian about the way in which, fuel needed the energy to produce that fuel, and the fuel was food, etc. What did those conversations sort of teach you? What were the sort of the key learnings at that point in time from those conversations?
Well, I thought that I was pretty good at business. I had been advising all sorts of different businesses in an attempt to build up enough to build a business that would allow me to buy land. And there is what's called the standard theory of the firm, which is as you drive yield, so you create more margin. Well, the conversations with Brian, I mean, Brian tells the story better than I do. He had a light bulb moment with this: food is a fuel is energy, and that actually the costs when running a farm business, you have to decompose some of the costs, the variable costs, and you have to attribute some of the variable costs to the free issue energy, and some of the variable costs to the industrial energy that we use in form of fertilizer or feed or non-essential better meds, etc. And that was, I can still remember the first non-linear break-even chart that Brian sent me. And full of excitement, I took it to a guy called Gary Smith, who then probably still is the deputy chief executive or whatever he's called of the Yorkshire Dales National Park. And we sat round his kitchen table in Grassington, and there was me trying to explain these non-linear variable costs to a conservationist who actually got quite excited. I'm not quite sure where he is now on all this. He's probably bored stiff of me. But that's what happened around our kitchen table. And Brian, you tell the story of your farming background.
Yeah, Brian, I want to move on to talking about balance sheets and so on in just a moment, but perhaps you could start by telling us about that light bulb moment.
Well, I don't have a farming background. I was in my late 50s before I ever set foot on a farm. They just weren't part of my career or my life. But I'd known Chris for a very long time, since the early 80s. And we talked about various issues related to farming, but that was about it. When Chris described the phenomenon of downsizing and being more profitable, my first inclination was to think, well, how the devil can that happen, given the standard theory of the firm? And I realized that the variable cost line had to have a kink in it somewhere. So we produced a variable cost line which explained what was happening. But then the question was, why is it happening? Why is it that shape? That's the only way it could happen, but why is it happening? And the realization was when Chris said, well, food is a fuel, it was obvious that there were two sorts of energy in the equation. And that was the way it was coming out in the farming world. The first thing you do is use the sunlight, and then you correct for it afterwards when there's not enough of it. And those two things have very different cost equations. It was as simple as that.
Now, for lots of farmers, of course, farming isn't always thought of in terms of being a business. And you know, I'm sure there are people listening who will feel slightly offended by that. And just to sort of qualify it, there are lots of fantastic farmers who are clearly incredibly good at business as well. But for a lot of farmers, you know, it's a way of life, often inherited. It's been fairly subsidy dependent, and in many cases, it's been very, you know, sort of financially support dependent. And so many farms don't run as normal businesses would. Can you talk me through the importance of the balance sheet, of understanding those fixed and current assets and liabilities?
Well, what's not generally realized is that money has got two aspects to it. It's got amount and it's got term. In other words, a £5 note in your back pocket is very different if it's there for a week as to whether it's there for a year. The term aspect of money is often forgotten. And it's very complicated managing things with two aspects to them. Well, the Italians came up with the idea of separating this out into a profit and loss account where the amount is and a balance sheet where the term is. We measure the balance sheet in pound notes, of course, but it's really time that's on the balance sheet. And the balance sheet is the repository of the capital in a business. Now, capital is very important in farming because, frankly, it's all about the conversion of a natural capital asset. And what's been happening in farming, which has been masked by subsidies and support, is that farms have been decapitalizing. And if farmers had a better understanding of the balance sheet and how it works and what's important about it, they would have a better grip on those things that they're doing, which are in fact leading to a decapitalization. And that's why it's important. It's not difficult. Almost every farmer we've come across, without exception, is quite capable of handling it.
What we know from the 360 farms that we have reviewed, that 80% of those farms have a negative second contribution. So they don't cover their variable and fixed costs on a pre-support basis. That means that those farms are decapitalizing. They have to, in some way, fund that loss on a pre-support basis. Now, that isn't actually very good value for the support that farmers are getting because it's going into a loss make to support the loss. So this concept of the balance sheet and understanding why it is important is imperative.
So what you're talking about is farmers needing to understand where they are, where their business is in terms of profitability, without that sort of element of financial support associated with it? Or is it okay for people to think about that financial support? I guess it's a challenge because it's variable year on year.
Well, the support has been fundamental to agriculture for decades, and we shouldn't get rid of it, particularly in the way that it's currently going. But it is behoven on farmers, I think, to understand that support is uncertain. We don't know whether it's going to be there in 3 or 4 or 5 years' time, let alone 10 to 15 years' time. So for farmers to be successful, plan not to have support, and to get to your business to a position where it is provides a positive contribution to your variable and fixed costs.
And I suppose in terms of thinking about the future, that sort of idea of kind of standard support, acreage-based support, whatever else it happens to be, has essentially gone now. It's being phased out very, very rapidly. And instead, we're looking at how that funding comes in, different funding streams that are available through different grants or through natural capital. And so in that way, you've got a farm business which is potentially producing food and natural capital assets and delivering for nature, etc. So do you need to look at these income streams entirely separately as if they're different businesses within the single business, or are you able to sort of think about them and aggregate them together?
Well, I think you need to separate them. And let me give you one, I believe, fantastic example. There has been not one livestock farm that we have reviewed that have gone down the mob grazing / herbal lay route that have improved their profitability. They're going on a pre-support basis. Okay, they're going down the herbal lay mob grazing route because of the payments that are there. So when there is a payment offered to you through SFI or countryside stewardship or ELMS generally, ask yourself as a farm business person, ask yourself this question: will this prescription help me improve my profitability?
And in terms of that sort of regen element, the mob grazing element specifically, going back to that idea of land being an energy converter, if you're managing your cattle in a different way and therefore getting more grass, getting more energy out of that land that then gets, transferred into the animal, why isn't that sort of holding up in terms of profit?
The problem we have is this introduction of industrial energy through fertilizer and feed. That reduces your profitability hugely. It has a negative effect. It is on the surface counterintuitive. I was taught at college, the more yield, the more profit. But because there are two types of energy, that does not work. Maximizing output through your free issue solar energy is where farmers should be heading. When you use industrial energy based inputs, and Brian can talk about this, but we struggle with the economists who don't understand energy in the way that physicists and mathematicians and we do here. So when you use industrial energy, the energy that has gone into the manufacture of fertilizer, nitrogen fertilizer, for example, can never be recovered in the food that you sell as fuel. Because if that was possible to do that, you'd have a perpetual motion machine. And the energy required to supply a ton of fertilizer is so huge, it actually knocks the profitability of the farm. And not only that, it reduces the available natural capital significantly.
So what we're talking about, Brian, I guess, is understanding those different forms of energy and, to all intents and purposes, as far as possible, trying to eliminate that sort of synthetic form of energy that's going into the farm there that Chris was just talking about, so that you're able to benefit from the energy that's coming from the sun, that you're able to transfer and change into grass or other products that are coming from the land.
Yes, it's exactly that. You see, industrial energy is not only expensive, but the conversions are such that you can't ever win. And this is where economists are failing. You see, most economic theory is really about price, and even worse, it's about marginal price or marginal cost. They don't look at the business in terms of what's driving it. And what's driving it is energy, and they have no models that are energy-based or can account for the special peculiarities of working with energy. Broadly speaking, if you're in livestock farming, there's nothing you can do better than to grow as much good grass as possible, and it's as simple as that. And don't put any artificial inputs into the equation. And that's your primary position.
And if we just sort of move on to the idea of profit, we've talked around it a little bit. We've used the word, and the book, of course, is called The Profitable Farm. But I think it's important to sort of outline what we mean by profit and be really clear about that, and to talk about why that is more important than other measures such as yield. And I know we've touched on this, but if you could just sort of go into a bit more detail on that, Brian, that would be helpful.
Yeah. Well, a profit can be measured at different levels, and the purpose of profit changes according to the level that you're looking at. So, for example, the first thing a business should do is to cover its variable costs. If you don't cover variable costs, you will be losing cash. And that, of course, is just unsustainable in a basic economic sense. Then the surpluses you have in producing cash should then cover your fixed costs. If you don't cover those, you will be decapitalizing. And the whole idea then is to provide a surplus, which will then service the assets you have and purchased, because they will have come into the business at a real cost and deserve a return. And then beyond that, you're faced with having a surplus to live off and support your own lifestyle. The problem with yield is that you can almost certainly produce more and more and more of any farm output by throwing more and more industrial energy at it. It's what we did in the war. But then, of course, we wanted the output. The cost was irrelevant. But that mentality hasn't entirely disappeared. So profitability is a hierarchy, is serving a hierarchy of objectives. First of all, don't lose cash. Secondly, don't decapitalize. Thirdly, make sure that you can support the assets you've purchased. And fourthly, have enough surplus to live comfortably and maintain your lifestyle. And those are the 4 steps that you should always have in mind. But farming is a business at the end of the day. And unless it can satisfy those business objectives, a farmer will leave the farm, and that activity will just stop.
Now, that brings us on, I suppose, to the concept that you arrived at that underpins the book, which is maximum sustainable output, or MSO. Could you explain this in a bit more detail for us, Brian?
Well, let's take the word sustainable. In a sense, what we're trying to communicate is that whatever you do has got to be capable of recovering back to its original condition or even better. In other words, you don't want a system that's essentially running down. And that's what we mean by sustainability. Now, in some parts of farming, like cereal farming, the very fact of growing wheat depletes the soil of nitrogen. That deficit has to be restored. Now, there's a couple of ways of restoring it. You could restore it naturally, and the way to do that is to rotate the ground with livestock, say, and various other things. Or the way that has been chosen by the majority of farmers in the UK is to throw industrial energy at it in the form of fertilizer. That isn't working. Cereal farmers are not profitable. Not profitable in the way that Chris is talking about on a pre-support basis. They are profitable after support, and they get a huge amount of support.
Yeah, we've got examples of arable farms where their fixed costs are over 70% of their pre-support revenue. There's just no way that they can survive without significant amounts of support, which has been available largely because arable farms are much bigger than livestock farms.
So what's the solution there in terms of that approach around MSO? If we're thinking about arable farms, how do people need to think differently in order to be able to, manage that nitrogen deficit, for example?
Well, it can be done quite naturally. And there are things related to changing the varieties that are used. But the inevitable consequence is that the yields will go down. But the thing is that the profitability goes up at the same time. The problem for us as a nation is that as the yields go down, our output will go down. Although the farms will become more profitable. The question is, how do we supply the markets that we have with the grain that they need? Now, it's not entirely a hopeless case, because what we do know is that something like 40% of arable farms are growing food for animals. If you go to MSO, you won't need that. The animals will have an all grass-fed diet, and they will not need either artificial inputs or food grown for them. Now, if you release 40% of arable capacity and either use it for more livestock or more cereals production, say, even at a lower yield, you're starting to redress the balance.
So if we're thinking about arable and we're thinking about that transition to MSO, maximum sustainable output, then I guess the question is whether that transition can be funded effectively by the the savings that are created by removing that synthetic fertilizer and other synthetics, other industrials, from that farming system, because of course that saving only happens once. It only happens when that is initially taken out. But if you're saving 100,000 a year on your nitrogen fertilizer and you get rid of that, and you then start introducing that sort of greater variety within the crop, then the hope is, I guess, that the transition will be self-funding, and that after that, even though your yield has gone down, the profitability has increased.
It's difficult. It's difficult to self-fund. The cash flow implications are significant. You do get the benefit of a reduction in industrial inputs, and that is a positive effect on the cash flow. However, in arable farms, there has been a decapitalization, not just in natural capital, but in the farm's ability to have boundaries or fencing to hold livestock. And so there is a cash flow implication of the reinvestment in that farm. Sorry, Brian, I interrupted you.
No, what I was going to say was that it's not entirely a hopeless case. It takes about 275 kilograms of nitrogen per hectare to produce wheat. After that, the retained nitrogen level can drop dramatically. It's not unusual to find farms with after growing cereals with just 40 kilograms of nitrogen per hectare. But the thing is that if you start this conversion process at 40 and you started it more luckily at 160, after 4 years, there's almost no difference in the output of the farm. So, and that points to Chris's comment that it's a cash flow thing. It depends where you're starting from. And some farms are going to start from a long way back because they've depleted their soils so badly.
And I guess a key message there is, while that farm support still exists, and where that farm support can be attracted, for any other sort of elements under the sustainable farming incentive in England or other incentives elsewhere within the UK, it would be a good idea for farmers to get on with it while there is some support to assist that transition.
That's right. Well, I mean, one of the problems, frankly, with support at the moment is that it's coming in the form of covenants. The support is there, but there's a prescription behind it. Many of those prescriptions are not very helpful. They're designed to produce a landscape that looks like something rather than a landscape that's designed to produce.
Mm-hmm. You obviously go into much more detail on these things within the book itself, and so I strongly advise people to have a look at it. It's an excellent book which is sort of I'm not an economic specialist. I haven't done degrees in economics, but there's enough in there that I can sort of fully understand, as well as then having the greater detail for those people who can get into the economics with greater understanding. It's a really interesting read. But I wonder if you could talk me through, because we sort of looked at arable just briefly there. I'm interested in dairy, because dairy sort of works on a slightly different basis, where it's sort of almost two businesses within the same farm, where you've got the kind of the factory element, the production element, but then you've also got the cattle element as well.
It is two businesses. The dairy itself, the parlour, is a factory. It's not a farm. And because it's two businesses, it's best tackled with an understanding of the need for a transfer price between the farm and the dairy. It's very difficult for milk producers to get to grips with this, but it becomes easier to understand in the context of cheese making. We have farms who are involved in cheese making, and they use their own milk. And the interesting thing is, of course, if you produce a very attractive cheese, you can command a price in the marketplace. The question is how you price that cheese. And we've had a case where the issue was the milk was being transferred to the cheese business at the market price for milk. And the cheese was being sold profitably and quite successfully. But it wasn't meeting its potential price premium. And the reason was that if they transferred the milk at a different price, they could have easily recovered it in selling the cheese. Now, if you take that one step backwards, what you have to do is to work out the transfer price from the farm to the dairy parlor so that the farm is profitable. And when the price of milk was 32 pence a litre, we were able to help a cheese business work on the basis of their milk transfer price from their farm to the milking parlor at £1.20. And then
why was that? Why did that price go up?
Well, because that was the cost that was necessary to make the farm profitable.
Mm-hmm.
We did it the other way around. What you're doing is you're selling a product, but you have a duty to make the supplier, the farm, profitable. Now, in dairy, milk prices drive everything, and sometimes the milk prices are really quite generous. To be honest, there's no reason why you can't make money, but there's a tendency to leave the farm unprofitable and think that all the profit is coming from the conversion in the dairy. Well, it's not. There are also other problems in dairy, which have an MSO type implication. Milk buyers are driven by their own carbon offset objectives. And broadly speaking, they're very simple. They want as few collections as possible for the output they sell so that they can reduce their diesel costs in collection. So there's an incentive for farms to produce as much as possible and drive the animals as hard as possible. Now, a farmer's got an option. If he's got an animal that's delivering 10,000 litres or even 12,000 litres of milk per annum, that animal will only have 1 or 1.5 lactation cycles of life. Well, his other option is to drive that animal at 6,000 and have 6 lactations. On a lifetime cost basis, that's much more sensible. And not only that, the cow benefits, the animal benefits as well. And what dairy farms have to do eventually is get back to the position where their animals are all grass-fed.
And in terms of those dairy farms that you've worked with, you've talked about, cheese producers where the cheese is being produced on farm, and I imagine the same is true with ice cream and other sort of value-added products. Are there farms that you've worked with that have been able to become genuinely profitable simply producing liquid milk, or has it all been about the added value element?
I think the most profitable farm that we have dealt with was a dairy farm, was already at MSO without realizing it. They'd taken out most of their feed costs. They didn't use any fertilizer. And this was a lady that had come back to the farm from doing other things outside of agriculture, taken over from dad, who wasn't very well, and began to make changes. And the changes she made to become, in fact, she's probably the most profitable farm business that we've seen on a per hectare basis. She made changes, and she treated the farm as a business, like the business she came from outside of agriculture.
Yeah.
And what was she producing, Chris?
Milk, liquid milk.
Liquid milk. And
Yeah.
was she producing other things on the farm as well, or
No,
just it was
no.
purely liquid milk, and that was what
Liquid
was
milk.
creating the profit?
Liquid milk.
Yeah.
Yeah.
Well, we've come across one farm where when the milk price surged by about 10p a litre, was encouraged by their milk buyer to produce more. And take the argument was you can take advantage of the better price. Well, he did, and he lost money.
And why was that?
Because he was driving the extra output with industrial energy content.
Mm-hmm. Now, Chris, you start the chapter on maximum sustainable output in practice with a hierarchy of objectives. And first off, we have not losing cash with every transaction, which sounds straightforward, but as you say, it is something that happens on an awful lot of farms today. So it's hard to disagree with that as a concept. But how does this broader hierarchy inform farm business decisions?
Well, I mean, let's go back to basics and what we find. we have found that very few farmers, A, use cash flow accounts, cash flow budgeting, and B, look at their statutory accounts um, uh, in any useful way, and even fewer create a set of management accounts. When you are in business, you need to understand what decisions to make and why you're making them. And when you're in business, if your revenue, in farming terms, pre-support revenue, does not cover your variable costs, if you've got a livestock farm, you're just sticking a £50 note on the back of the animal as it goes out of the gate, because your revenue is not covering the fertilizer, feed, non-essential vet and meds. We have some farms that have vet and med costs that are 20 to 25% of their pre-support revenue. There's no way that they are going to make money. So make sure that your pre-support revenue with your variable costs taken off is positive. The next bit is your fixed costs. If you are negative at that point, it tells you where your business is and the first thing you have to do. You then look at your fixed costs. You take your fixed costs off the first contribution, your pre-support revenue minus your variable costs. Take your fixed costs off that, and are you positive or are you negative? If you are negative, that tells you something as well. And when you look at the percentage of first contribution against pre-support revenue and the percentage of second contribution against pre-support revenue, those numbers give you a hierarchy of decision making that allows you to make proper decisions. And as I said earlier, 80% of the farms do not have a positive contribution that covers their variable and fixed costs. They are entirely reliant on support. And it is this element, this reduction and uncertainty in support, that is causing such huge trauma in the farming industry. There's all sorts of reasons why we should be concentrating on well-being and mental health in farming. But the most important, in our experience, is to create a profitable farm business. When you do that, you can go to bed at night and wake up in the morning knowing that you don't have a financial axe hanging over you.
Fixed costs are a particular problem in farming. They're generally high. And apart from the obvious, in the sense that if you reduce your fixed costs, of course, you become more profitable. There is another effect which has gone under the radar, and it's this. If you reduce your fixed costs, your break-even point on the farm is lower. And that break-even point is a measure of your resilience. Fixed costs have a huge impact on the resilience of farms. And farm resilience is going to be more and more important when it comes to supply chain issues and to insurance.
It's really interesting hearing you talking about the fixed cost, because certainly in terms of livestock and, whether it's beef or with dairy, some of the work that we've done over the course of the last few years, both through the podcast, but also through Farmwell, which I ran beforehand, which was a think tank looking at regen ag, we found that, those farmers that were taking choices to outwinter their cattle, which was achievable with dairy in the same way that was achievable with beef, were able to either simply not build the barns that otherwise would be needed in the first place, or to reduce the number of barns that they had and thereby reduce those fixed costs. So again, that's regen providing that opportunity to minimize those fixed costs, which is really important. And I'm interested again, in those statistics that you were talking through there. So many farmers essentially, replacing the idea of the cash flow accounts with a wish and a prayer. But I wonder if you could just talk me through the difference between a cash flow account and a management account.
Well, for me, the first budgeting tool for a farmer is cash flow. And when we go into more detail in farm businesses, we look at cash flow, and we'll create a 12-month cash flow, maybe a 24-month, but generally a 12-month cash flow, where you just line up the months against the expenditure, and you end up finding what cash you have left at the end of each month and at the end of each year. And it doesn't half give you a feel-good factor. Even if it comes out negatively and you're not doing very well, at least you know, and you know which months are going to be problematic. And if you need to, you can go to the bank 2 months ahead of it, rather than at the moment when the problem has occurred. And it gives the bank confidence that you actually have some control over your business. Management accounting. Well, yeah, Brian, you talk about management accounting.
Well, the statutory accounts that we are obliged to produce are simply there for the government to be sure that our tax liabilities are properly assessed and we pay our taxes. Now, to be fair, from their standpoint, they allow all kinds of provisions and allowances and various other things. The net effect is that the number that you end up with has got no basis in reality. Management accounting is very simple. You take revenue, you take the variable costs off, and you take the fixed costs off of the period under consider. What's left is your profit. There's a difference between profit and liquidity, which is the importance of cash flow. Incredibly, the 07 banking crisis was the banks lost liquidity. The very center of our finance world weren't up to managing their own cash flows, and we all know what happened. What happened there? It is possible to have a business with positive cash flows that is not terribly profitable, and they tend to be businesses where the income comes in ahead of the expense. And that can mask the reality of profitability. In farming, it's the other way around. The expense is always going to come in before the income. And that's why cash flow is important.
So if I was to sort of summarize that briefly, then essentially the management accounts are things, which just outline the profitability. Those are the things that the government needs to assess the corporation tax, et cetera, whereas the cash flow accounting it's integrating a genuine understanding of how the money is moving and the liquidity of that business.
That's right. You've got to manage the money and try and bridge the gap between the expenses going out and the income that's coming in. I mean, many farmers they've got into the routine of depending entirely on their support payments because a couple of large checks come at certain points in the year and they can plan for it.
And they can cover a lot of bills.
That's right.
Yeah, they can cover a lot of ills, I suppose, when you have those sort of larger injections of cash coming through. Brian, we talked a little bit about arable. We talked a bit about dairy. I'm just wondering if you could, in terms of that sort of practical case study of maximum sustainable output in practice, you could talk me through a sheep farm example.
Well, we've got an interesting sheep story to tell, really. And it concerns what we would call false productivity. In parts of the north, there's a great affection for Swildales. And broadly speaking, the farmers who have Swildale flocks are really very good farmers. In 1946, you'd get something like 120 births per 100 ewes. And the breed's been modified and developed in the meantime, and it's now as high as 180 births, okay? Well, that sounds like good productivity. You're getting more lambs for the size of your flock. Unfortunately, nobody told the ewe to produce more milk. And the fact is that the extra births have to be supported with artificial inputs, because they can't be supported on the ewe's milk. Now, the cost of those inputs makes the whole thing unprofitable. So farmers who have had a real feel for their flock, technically quite competent, were trapped in a spiral where the productivity they thought they were engineering in was costing them more and more money and making them less and less profitable.
And not only that, the concentration on productivity in the form of more births led to a neglect, maybe too strong a word, but a neglect of the hardiness of those breeds to live outside on the hill in all weathers and in all seasons. And so some of the Swaledale have created a less hardy breed, and yet the Swaledale is all about hardiness on the hill, looking after themselves.
And so, of course, in addition to those sort of industrialized costs associated with, providing more milk from the outside, the cost of those sorts of inputs, you've got the additional cost on animal health and welfare, on resilience of that animal, and potentially the increased veterinary costs as well that you're sort of associating with that increase in the number of lambs. And it's interesting, when I was talking to Cora Cooper, who's a sheep farmer just up in Dumfries and Galloway, she was talking about the way that she actively works to try and make sure that she's selecting for ewes that are producing one lamb rather than the 2 or 3, or when I was scanning relatively recently, were sort of 4 or 5 lambs coming out of a single ewe.
Yeah, well, I mean, just another example away from sheep, but on beef, we're seeing belted Galloways being used for conservation type grazing in the southwest, and yet the indigenous local native breeds were bred to cope with the soil type, the soil structure, the vegetation, the grass. The belted Galloway is fantastic as a breed, but it doesn't outdo in profitability terms the local native breed, the Red Devons, and so on. And it'll be the same around the country. We can't afford to lose the genetics that have been built up over centuries that cope with a particular environment in a particular region of our country.
Mm-hmm. It's been really interesting, sort of having this sort of helicopter view over the top of the work that you've been involved in, because obviously the book is a crystallization of vast amounts of research and work that you've been doing over a number of years with all these different farm businesses that you've been talking about. But just before we kind of come towards the end, are there other things that we need to consider in terms of practical delivery of MSO that we haven't yet touched on?
Well, I think we need to understand very much what support is for. Is support to get a farm to break even? Or is support to get a farm to break even and pay the farmer a suitable salary? Or is support to underpin the building up and maintenance of natural capital, which supports the first two anyway? And so any support payments that come from government or are asked for by conservation bodies should be driven around one simple thing. And that is that if you adulterate or compromise nature in any way, you will be less profitable. And that can happen with overproduction and with underproduction. If you compromise nature by having too few stock, you will be less profitable, even with the support.
If you underproduce, because we live in a managed landscape, you will put stress on nature. And that stress will produce a dominant species. And that dominant species will prevail until a new equilibrium is established. That could take decades, might even take centuries. So the landscape's got to be worked hard, but unadulterated. We've got to work it hard. We can't afford not to work it hard. You see, one of the things that worries me is that people talk about support these days in terms of public goods. What they're thinking of is the appearance of the landscape. The appearance is irrelevant. The appearance will be right when the landscape is worked properly and worked hard. It'll look.
But public goods isn't just about the appearance, is it? It's about it's recognizing the value of nature itself, of that carbon sequestration, of the appearance, but also the access. So there's a whole range of different things sort of accounted for within the public goods sort of idea, isn't there?
Well, first of all, on the carbon side, just go back to 1750. In 1750, farming was responsible for 100% of our carbon emissions. We were quite happy at 100%. It's 25% now, or by some measures, but it hasn't really changed. The problem is the 75% that's not farming. It's not farming. Farming's got nothing to do with carbon emissions. That's a complete and that's a red herring.
But it brings us back, doesn't it, to the idea of the industrial inputs, because at that point it's those
industrial
synthetic
inputs, absolutely.
Yeah.
The industrial inputs are a source of carbon emissions, and reducing those would benefit everybody, and farming has a part to play in that. Another problem is that people talk about biodiversity net gain. Well, we're going to get all sorts of biodiversity net gain through climate change, and a lot of the net gain are going to be pests that we don't want. That's a red herring too. The issue is bioabundancy. We want more of the things that work, not more things.
Mm-hmm.
More things are a nuisance. We need more of the things that work. And there'll be different things on different farms and in different environments. And that's where the biodiversity is, not on a single farm, but in the patchwork of farms.
Yeah, I mean, there's an awful lot that you're touching on there. That's almost a whole different set of conversations. But there's certainly, for a long time, I felt that the focus on carbon emissions is less important than what we ought to be having, which is the focus on fossil fuel use. You know, if we eliminate or greatly reduce our use of fossil fuels, which again is this industrial energy, then we eliminate the problem that we're actually, and so the emissions almost are a proxy towards doing what we actually want to do.
And industrial energy is the right term, really, because wind energy that's used to produce fertilizer is industrial energy. It's not, the fact that some people think of it as renewables puts it in a different category. Nonsense. It's industrial energy.
So just a couple of other things, observations, Finlay, if I can. We cannot have a food security policy that works for our nation unless the businesses and the industry that underpin that food security, farmers, are profitable, are inherently profitable. And they are, at the moment, inherently unprofitable. So the food security that we supposedly have with this increase in yield through industrial energy is a fallacy. And the second point I just observe, and Brian will want to come in on this as well, we were asked to do some calculations on the energy output of beef cattle compared to the energy output of solar panels going onto farmland. And beef cattle outperform solar panels significantly. So replacing proper farming with solar panels is hugely detrimental to our countryside, to our nation, to our food security, to our ability to produce energy.
What we found, Finlo, was that energy has a common measure, and let's call it a megawatt, which is the way electricity producers would measure their capacity. We looked at what it would cost to produce a megawatt of capacity in the form of beef and a megawatt of capacity in the form of solar panels. And beef beat the solar panels by 6-1. Now, the paradox is that if you converted a field that's been growing wheat into a field of solar panels, instead of getting 1,200 pounds a hectare from the wheat or whatever it is, you might get 10,000 pounds per hectare from the solar panels. And that seems to a lot of people like a good argument to convert to solar panels. But that's not the real choice. It's a hierarchy of another kind that's gone wrong. The real choice is that we can't afford solar panels because nuclear is about 1/10 of the cost.
It's interesting, isn't it? Because, of
We're
course,
solving the wrong problem.
what we're talking about, we're almost comparing apples and pears, because although we're sort of comparing the energy output that's created, what we're talking about in terms of beef is energy that's going into human beings so that they can work and live and be healthy, as opposed to solar panels, which are creating electricity, which are producing the things for us to produce podcasts and have mobile phones and all these other different elements. And so it's a case of prioritizing, isn't it, where that energy is going. And I guess the most efficient use of that land, perhaps, is to have the solar panels and the sheep in the same place.
And you do that,
Mm.
which is not possible yet, but it should be possible by rotating the solar panels around the farm.
Mm.
In fact, they could be an interesting way of solving the nitrogen deficit in our cereals production.
Mm.
That part of the rotation, instead of livestock, could be for a solar panel, because the objective is to restore that nitrogen deficit.
And to be clear, there is absolutely no reason why that can't take place. It's just simply that the solar panels that are going in at the moment are the cheapest that the company can manage to achieve. So sticking them effectively on trolleys would cost more, in the same way that we've looked at the way that solar energy panels can be put, could potentially be put much higher up, so that, you know, they're effectively creating shade for larger livestock like cattle as well. Whereas, you know, we're used to seeing sheep underneath solar panels, but it doesn't have to just be that way. Look, we're coming towards the end of the program, and I appreciate that we got into quite an interesting conversation here, and I'd quite like to continue it, but at the same time, you know, our hour is more or less up. And I just wonder if we can zoom out and think about what a transition to maximum sustainable output would mean for farming in aggregate, and how MSO could improve the future resilience for farm businesses overall, and potentially how we get there.
Well, we have to understand, well, we go back right to the beginning. Farmers are the most important converters of energy. We cannot do without the farmers. It is vital that we keep them going. Now, we may get an aggregation of farmland, but for farmers to keep going, they need to be profitable. For farmers to be profitable, they need to reduce significantly the amount of industrial energy inputs on their farm. You cannot get more energy out than you put in. It is not possible. And when you take that alongside the fact, and I emphasize the word fact, the fact that if you compromise or adulterate nature, you will be less profitable.
In aggregate, let's suppose that at a stroke, as a nation, we went to MSO tomorrow on both livestock and cereal farming. Farm outputs would fall by 15% overnight, certainly on the livestock side. However, by going to MSO, you would release 40% more arable land, because that's standing behind animal feed, and you don't need that at MSO. We also know that 15% you lose on the livestock side will probably recover in 4 to 5 years as natural fertility improves. So going to MSO can have a number of benefits. You can get back to where you started after cutting out industrial inputs. You will release more arable land for an alternative use, and that alternative use can be more grain production or even more conversion to livestock. The thing is positive. And this is where people like the NFU get it all wrong when they're thinking about national food security. They think in terms of pure output, and they can't get off the issue that that's driven by yield. They have no concept of profitability. As they see it, profitability problems are simply solved by getting the government to stamp up more.
No, I think that's a really important point. And just, you know, to sort of bring us to the end, Chris, you were talking, I wanted to ask you about, you know, what the role is for government in helping to deliver MSO in aggregate at a sort of nationwide level. But you know, as part of that, you started talking earlier on about what farm support should be for. And I don't think you quite finished that thought, or at least I didn't quite understand where you got to. So how should farm support be used and understood in order to help deliver MSO?
So farm support should be used to increase or maintain natural capital. And the way you do that is by moving to the point of maximum sustainable output. Mm-hmm. And so the requirement for support in this country, in my view, in our view, is to help farmers move to that MSO point. And we haven't talked very much about it. I've mentioned it, but we have empirical evidence, 100 to 150 data points on 360 plus farms that it backs up everything that's in the book, that counteracts the standard theory that we've been following in agriculture. And so government should be helping farmers to become more profitable by seeing them through the cash flow problems that are going to occur moving from where they are now to MSO. And it applies to those below MSO, to those who are above MSO. They should be helping farmers balance the profit ball on top of the profit peak and not allowing it to go down too far one side or the other. And then we'll have a sustainable food security policy and profitable farmers that can run our managed landscape and develop it in the way that they've done for centuries.
People working below MSO are a bigger problem to this economy than people working above MSO. And we should certainly not use support to encourage people to work below MSO. And yet that is quite a common phenomenon. A lot of people think they're doing a great thing for the landscape and the economy and nature by working below MSO. In fact, they are doing a great disservice to the national economy.
We don't have a single farm, Finlo, that has taken payments to reduce their stocking rates below MSO, the MSO point. Not one of those farms is more profitable by doing that. They are less profitable by producing less food, even with the payments. It is quite extraordinary. It's a really salutary exercise. That we've got a big meeting coming up in the north of England to discuss this very point where the farmer is being encouraged to reduce their output to such an extent that it is going to jeopardize their business, even with the payments.
Yeah, covenants are a curse, really.
Yeah. Yeah, so it sounds like, an awful lot of farmers would benefit. I mean, the vast majority of farmers would benefit from understanding your concept of maximum sustainable output. And of course, the best way that they can do that is to get hold of the book, which I'll explain in just a moment. But that has brought us to the end. And thanks so much, both. It's been really fascinating. It's quite a dense topic at times, but you've done a great job of helping to explain it. And that's been fantastic. That is all we have time for. I'd like to thank my guests, Brian Scanlon and Chris Clark. Their book, The Profitable Farm, is fantastically useful. As I say, there's something for everybody there, for every farmer, and for everybody that wants to understand how farming should become profitable and how farming can sort of deliver that maximum sustainable output. And it's available to buy now. It's published by Unbreaking, an imprint of 5M Books. And if you've enjoyed listening, please come back and listen to more. Tell your friends, like us, review us, and share our links. Farmgate is now the highest ranking UK podcast for regen farming and food security. Farmgate leaders, Wheat from the Chaff, Nature Friendly Farmgate, and our Filling the Funding Gap series are all available if you just scroll back in your podcast feeds. Farmgate is part of 8.9.com, the land use news channel, which is sponsored by First Milk, Pelican Ag, Rural Solutions, the USC Catchment Partnership, Agrolo, and individual donors. I've been Finlo Costain. Bye for now.